So we have a really fun topic today because this is something that I think we all tend to instinctively shy away from, or we're in denial about, and we really just don't want to address. But we've had the opportunity to get to know an expert in this space who breaks it all down, makes it very easy to digest, and really tells us what we need to know. So I think the topic is very timely considering we're still at the beginning of the year. And you all know me, so I don't think I need to reintroduce myself, but I have been doing these webinars actually since the beginning of COVID. Somebody asked me the other day, how long have we been doing these? And when COVID hit, our first one was the week after, I think it was it March 20th of 2020? Anyway, that date stays in my mind. But we started these webinars at that time because we were looking for a way to keep the nonprofit community happy and excited and engaged about the work they were doing, even though so much was happening around us. It kind of feels a little like that right now. But anyway, so it really was just sort of born out of this feeling that we wanted to make sure we kept everyone together, and we've continued doing them. So here we are, and gosh, so now it's year 5. I think we had a little break in between, but we're really committed to making sure that everyone gets access to the knowledge and the resources that are going to make them excellent in what they do and really deliver amazing impact. So today I'm super excited to have Jackie Mclaughlin with us from Chazen and Company. And Jackie is a CPA. She's the technical reviews and training manager for the company. She has over 35 years of accounting experience, including 18 years dedicated to nonprofit organizations. She started her career at KPMG auditing tech startups, then advanced to audit leadership roles in Fortune 500 companies before she transitioned to nonprofit financial management. At Chazen and Company, Jackie oversees technical reviews, training, and financial reviews, ensuring that nonprofits meet the highest standards of fiscal responsibility. She's an accomplished educator and has spent 10 years as a top-rated instructor for the nation's largest CPA review provider and has taught financial tools and strategies to small business owners and CPAs. Her sessions empower association professionals to innovate, lead with confidence, and drive positive change through strong financial foundations. I'm going to stop sharing because we're going to switch over to Jackie's screen. And while we do that, I want to quickly mention Jackie has a similar philosophy to mine when it comes to training workshops and sessions like this. She really would like to be, let's not say interrupted, but she'd like questions to come to the surface as she's going through that particular segment so that the content, the messaging, the response that she has pertains to that topic as she's on it. So please go ahead and put your question in the chat if you have one. And maybe what we can do to make it really easy for us to skim through and find the question, maybe you can either put it in all caps or maybe put question, colon. Let's do that. Question, colon, and then your question. Because otherwise, please make comments in the chat. We'd love to hear your feedback and your input as we're going along. If you want to introduce yourself in the chat, we always love that too. But I think if we just put question, colon, and then put the question, that way Tanaka or I or one of the team will pick it up and we'll be able to stop Jackie real quick and have her talk through it. Oh, we've got our first question. Thank you, Sarah Crane. Do you have a list or template of financial policies and procedures you recommend all nonprofits have internal financial controls? Well, eager beaver Sarah, I'm going to let Jackie get to that in just a moment. She probably does, but I'll let Jackie answer that. Anyway, Jackie, it is so wonderful to have you here. Thank you very much. We're excited. You know, to me, this is the big elephant in the room is the financials, the financial controls, the finances, and let's just deal with it head on. Let's just, knock that fear down and learn as much as we can today. And in a simple way, right? Digestible. That's the idea.
Absolutely. Well, thank you so much for having me, Kirsten. I want to answer the question we've gotten so far. So there is not a template or checklist that I can provide you with good financial practices because those are dependent on the size of your organization and how many people you can devote to financial transactions. So, I mean, the auditors will when you're an auditor, you have a list of best practices, but you have to bob and weave those for an organization's budget. Obviously, if you're a $5 million revenue per year producing organization, you can't have the same number of people that IBM has to execute all of those controls. So they need to really be tailored to your particular organization.
Great.
That said, Kirsten, can you see the screen? Did I successfully share?
I can see your screen.
Yes, we can.
Perfect. Thank you. All right, well, we'll jump right in. And I should correct Kirsten a little bit. She said I'm a CPA. I like to call myself a recovering CPA because I don't use words like debits and credits and ASC 606 and words that nobody but geeky accountants understand. So this is a step in my recovery process. Why should you care about finances? Well, as a nonprofit, you need to be transparent and accountable to all of your stakeholders, but specifically your donors and your grantors. If you have a for-profit organization and you own it, it's a single-owned organization with no shareholders, you can play your finances close to the vest all you want. But when you're a nonprofit and you're soliciting money from others, you need to be transparent. Some of you may need to have a charitable solicitation license. This is unique state by state. Each state has different rules around their charitable solicitation license. 49 out of 50 have a requirement to get a charitable solicitation license. I'm often asked, who doesn't? Pennsylvania. Pennsylvania is the odd man out. And of course, all of you, unless you're a church and a few other smaller exemptions, but most of you need to file a tax return with the 990. So the IRS needs you to care about finances so that you're reporting money on your tax return correctly. Quick little cut to the chase for a minute. I met with a fundraiser last week, a professional fundraiser, who told me that larger donors and grantors actually do pull up those 990s because they are public record on GuideStar and Charity Navigator, places like that. They actually do look at those 990s, and sometimes they have some tough questions, and we're going to speak to some of those tough questions later on. And then, of course, you need to care about finances because I compare finances to a healthy eating practice. When you eat healthfully, you don't really need to worry as much about health issues as people who don't eat healthfully. So your primary purpose in eating healthy is to eat healthy because it's the right thing to do. And then guess what? You get lots of added benefits from that. You have better health, your BMI looks better, all of those, it's easier for you to be active. All of those things come out of eating healthy. And finances are the same way. You should seek to have good financial habits because of the very interesting stories it's going to tell you. And I'm going to talk about that as well. And so if you have good financial practices to tell the good story or read the good story, everything else will fall out from there. The IRS will be happy. Your charitable solicitation license will be happy. Your donors and grantors will be happy. Everyone will be happy. And your organization will be more sustainable. Okay, this is why probably a lot of you want to bury your head in the sand about the finances, which is a very normal thing, by the way. If you're one of those people, very, very normal to want to bury your head in the sand unless you're an accountant. And why you may want to do that is because it just seems so difficult, because you have a lot of accountants who aren't recovering like me, who talk to you about debits and credits and things that you don't understand, and they don't explain it to you. And so you just say, I'm out. I'm not listening. I'm out. I don't understand this. It's not that hard. And I'm going to hopefully walk you through that today. It's not that hard. The nonprofit leader doesn't need to understand GAAP, which is short for Generally Accepted Accounting Principle. The nonprofit leader doesn't need to understand debits and credits or any other confusing jargon. All the nonprofit leader needs to understand is cash in and cash out. The accountants can take it from there. So to begin your new journey with wanting to understand your organization's finances, you've got to overcome your discomfort. And how do you do that? You change your perspective on numbers. You change your perspective. So the story that I love to tell is if I were to go to China, I don't speak Mandarin or Cantonese. I would need to hire a translator to translate that language for me so that I can enjoy my visit in China. For all of you, some, or not all of you, but some of you, the numbers are like looking at Mandarin or Cantonese. So you need somebody to translate that for you, or you need to be taught a few words, which we're going to do here today, so that you understand the stories that your financials are going to tell you. So that said, let's dive in. The first thing you need to know is that nonprofits have different names for their financial documents. So you can see on the left, we have the for-profit names, and you're probably familiar with these: balance sheet, P&L, statement of cash flows, budget versus actual. On the right is the nonprofit name. They call the balance sheet statement of financial position. They call the P&L statement of activities. All the rest has the same name. For the purpose of this conversation right now, I'm going to use balance sheet and P&L. That's the terminology I'm going to use throughout, because most of you are familiar with those terms. And I don't want your brain going, wait, what did she say the statement of financial position was? I don't remember. So we're not going to use those terms. We're going to use balance sheet and P&L. I love this slide because whenever I say it, my accountant counterparts go, oh, what are you doing? So I compare financial statements and LeBron James. Yeah, I'm going there. I'm going there. So I don't know much about basketball. I know enough to be dangerous, but I know that LeBron has season stats. And all these statisticians love to keep track of LeBron's season stats. So I just imagine, since I don't know much about basketball, what might be some of his season stats. They're probably tracking how many points he puts on the board, his number of assists, the number of free throws he made. I'm sure there's a lot more, but that's the type of thing that LeBron, his manager, his coach, the fans, people are tracking these season stats on LeBron. When this season ends, he'll start all over again next season with new stats. So in other words, at the beginning of next season, his stats are 0 until he plays his first game. What happened to his stats from this season? Did they just go away, never to be seen again? No, his stats from this season get aggregated in with his career stats. So his season stats at the end of the season will zero out, and they'll aggregate in with his career stats. Well, your organization does that too. LeBron's season stats are your P&L. LeBron's career stats are your balance sheet. Now, here's the other thing. Oh, I'm sorry.
Can I ask a quick question? Can everyone see the slides?
Yes, we can.
Wonderful. Thank you. Just checking. Thank you so much.
So after every game, LeBron watches, I'm going to use the word film. I don't know what the right word is. LeBron watches a film of his performance from the game he just finished. And you should do that too. You should look at your film of your performance at the end of every month. And for you, your film is called a budget to actual report. When LeBron looks at his film for the game he just ended, LeBron's looking for a couple of things. He's absolutely looking for what he did wrong so he can correct it at the next game. He's also looking for what he did right so that he can do more of what he did right. And this is one thing I think all leaders, not just nonprofit leaders, but all leaders forget that second piece, which is look at what you did right also and say to yourself, how can I do more of this? How can we do more of this? Now, LeBron may have a bad game. And I think if I ask anybody on here, basketball fan or not, and I said, hey, if LeBron has a bad game, you think he's going to have a bad season? And everyone would answer, no. One bad game does not make a bad season. Similarly, a month where you have a bad P&L doesn't make for a bad year. But when LeBron will have a bad season is if he has a bad game and he doesn't review his film. He never reviews his film until the end of the season. If I asked all of you, what would happen to LeBron's game if he doesn't review his film till the end of the season? All of you would say, well, he's going to have a bad season. Yeah. And that's what many, many businesses and nonprofits do as well. They only review their budget to actual, i.e. their financial performance, once a year. And many nonprofits wait until it's audit time. And by that time, you're really looking at your performance about 16 months in arrears. So it's crucially important that you look at it monthly. So here's an example of a budget versus actual. It's all made up. You can tell by the headings there. It's probably a school because I've got tuition billing at the top. And you can see there's a budget variance column. So this is an example of something that you should be reviewing every single month. This is equivalent to you being LeBron and reviewing your film of your previous performance. I've highlighted some numbers here in yellow because those are the large variances that you want to look into. So if you go down, I don't know, 5 or 6 lines, you can see employer, FICA, Medicare. There's a variance of $101. You absolutely don't want to waste your time with that. Who cares? On 2 million in revenue, who cares? And further on down, there's a variance of $86. Who cares? However, if you go back to the top, under tuition billing, you've got a positive variance. You brought in more tuition billing than you budgeted for. Why? That's an example of a good variance. What did you do right? I'm going to tell you, epilogue here. You brought in more students or you raised your price of tuition, one or the other. If you brought in more students, how can you do more of that? What did you do that brought in more students so that you can continue to replicate that? Now, way down towards the bottom, I have a highlighted number, $32,622. You went over budget, but that's on student room and board. Well, wait a minute. You also brought in more revenue at the tip top. So you would expect to be over budget. And in this particular case, it's not a bad thing. You being over budget on your expenses is consistent with you being over budget on your revenue.
Question.
Mm-hmm.
And it's about budgets, and maybe you're going to address that separately, but I'll just go ahead and ask the question. Do you recommend breaking our budget down to a monthly basis or just keeping it in mind where the annual goal is and making sure we're on pace?
Well, I love this question because you're going to see my passion again. Your budget should absolutely be monthly. Otherwise, it's not as informational for you. And you all hate budgets, and I get that, but I'm going to make you very happy. Let's reframe budgets for a minute. If you proactively put some time and effort into doing a good, reasonable budget, it will help your decision fatigue. And when I say this, people go, what are you talking about? How's it going to help decision fatigue? Because throughout the year, when your staff comes to every single day with 10 fabulous ideas, which I've noticed nonprofit staffs usually do that, they come to you every day with 10 fabulous ideas. You don't need to think about it. You look at them and you say, is it in the budget? Yes. Okay, then why are you asking me about it? Go execute it. No, then you're not doing it. You didn't budget for it. Put it in your notes to budget for next year. So it will help your decision fatigue throughout the year because this is meant to be a map. Another good example I like to use. If you're going to drive from New York to California and you don't have a GPS or a map, you're going to head west. Who knows where you'll wind up? Your budget is that GPS or map to help you get efficiently from New York to California. It's also, by the way, an annual representation of your 5-year strategic plan, because your budget should absolutely spin off your 5-year strategic plan. And you'll notice I have for internal use on this, and that's because we're also going to talk about the way an auditor presents financial statements, which is a little bit different, but very important to your donors and your grantors. But in this situation, this is something that nonprofit leaders can understand very, very easily. A nonprofit leader, if they see tuition billing, they know exactly what that is. Oh yeah, how much did my students pay me this month for school? Nonprofit leader can look at telephone and internet, which is halfway down. Oh yeah, that's how much I spent on my cell phone bill. So very easily understandable. Now, here's the other thing that a lot of non-accountants don't understand. These titles that I have here, tuition billing, application fees, et cetera, they can be customized for you. So to make just a crazy example, you can see halfway down, I've got utilities on here. Well, if utilities doesn't resonate with you, call it gas and electric. It doesn't matter what you call it. You need to call it what resonates with you and your team. Call it the water bill, call it the trash bill, call it whatever you want, because by naming these accounts appropriately, you're also helping decision fatigue and errors. The last thing you need is your people who code bills having to scroll through 500 accounts trying to figure out what to code something to because they don't understand the language, because the language was written for accountants and not the people who actually are doing the coding work. No, the language should be written for the people who do the coding work, and the accountant should adapt.
Makes perfect sense. Quick question for you, Jackie. You mentioned tying this to the 5-year strategic plan. Can you expand on that just a little bit?
So typically organizations have a 5-year strategic plan. Now, some of you, it might be 3 or 10 or whatever, but I use 5 as an example. Obviously, you can't do everything in that 5-year plan in 1 year. If you could, it wouldn't be called a 5-year plan. So every year when you do your budget, you choose one of those pillars from the 5-year strategic plan that you're going to focus on this year. And that's what your budget should revolve around, is that pillar you're going to focus on this year.
Perfect. Thank you.
Okay, so now we're getting into the season stats, or LeBron season stats, also known as the P&L, or Statement of Activities for Nonprofits. This is what an auditor will present you. And I want to draw your eye to a couple of things because this is important. Notice that for 20x2, you have 3 columns: without donor restriction, with donor restriction, and total. And obviously that total column is without donor restriction plus with donor restriction is that total. I also, and we're going to talk more about that in a minute, but I just want to draw your eye there right now. I also want to draw your eye down to expenses. See, this looks a little different than that budget to actual report. The expenses are split between program expenses and supporting services. And supporting services are further segregated into management in general and fundraising. And we're going to talk more about this segregation of expenses that's really important, where all of you are going to want to focus in on this. And then finally, I want to draw your attention 3 lines from the bottom: changes in net asset. This is what all of you would think of as your profit or loss for the year. So with this organization specifically, and I don't know if you can see my cursor, but they made $478,000 that year. They had a profit of $478,000 that year. And we're going to pull all these pieces apart further in some upcoming slides. But I want to myth bust here. And the myth is that nonprofits can't make a profit, and they can. And in fact, you should, because if you don't, you can't sustain yourself for year over year over year. And this is no different absolutely no different than your personal finances. If you don't bring more into your home every month than you spend, you can't save. And if you can't save, you can't sustain your family year over year over year. You've got to bring in more than you spend. The other thing we're going to touch on while I'm talking about your personal finances here is that nonprofits also work the same as you and your personal money, in that if you're like most people, you have your checking account, which pays your mortgage and your utilities and your food and all the normal bills. You have an emergency savings or vacation savings. Sometimes they're combined together. And you have retirement savings. And your goal in your retirement savings is never to touch it. So until you retire, of course, but keep that in mind as we continue to go through this, because nonprofits work the same way.
I have a question.
Mhm.
How do smaller nonprofits overcome the challenge of limited human resources with the necessity to have clear and accurate financials for donors and grantors? It always seems like it's a hurdle.
Love that question. You're going to get me off on a rant. Two ways: technology in our experience. So Chazen is an outsourced accounting firm. So in our experience, when we first get involved with nonprofits, their technology is antiquated. And as I always tell new clients when we're talking to them about what we can do for them, you know, I can, in 2 clicks of a mouse, I can have ice cream at my door in 2 hours. But yet some nonprofits have technology that's so old, and even if it's not technically old, it just hasn't been updated, that it might take them 10 clicks of a mouse to process a transaction. So that's not consistent with new technology. And additionally, part of the reason that nonprofits, I think, don't think to upgrade their software is because back in the day when they got their Great Plains or whatever they got, it was very costly. And it's not anymore. It's very, very affordable. So one, you've got to upgrade your technology. The other thing I see nonprofits do, and I'll give you an example of a client we had where their processes, I say with all love in my heart, were designed in 1978, and they had never upgraded their process. So they would have one invoice come in the door, and it would be coded by the manager responsible for that area. And 5 people reviewed the coding, 5, before it ever went into the computer. And then it was put in the computer, and before it was posted, there was a 6th person who reviewed it. So that is what and I get a lot of pushback on this, but that's too much internal controls. And too much internal controls is not cost efficient, and it slows your staff down. So you need more staff to do a lot of stuff that doesn't add a lot of value. There is zero value in having 5 sets of eyes on that transaction before it goes into the computer. So did I answer that question, Kirsten?
Yeah, I think there might also be a little, you definitely cut sort of streamlining, you address the streamlining a little bit, but I think there may still be a concern with how do we afford bookkeeping or accounting services when we're a small operation and we don't have the ability to expand our team. Oh, okay, good. Michelle says you answered it. Fantastic.
I did answer it. Okay.
But you're welcome to address the other issue too at some point in your conversation.
Well, sure. I think I would address how do we afford to have a bookkeeping staff when our resources are limited. And I don't know how to say this super nicely, but you don't have a choice, because you do have to file a 990, and your bookkeeping staff isn't going to do that, but they've got to have everything in order so the 990 can be filed. It's kind of like you don't have a choice to put a roof over your head. You have to do it. So it's got to be incorporated in your budget.
Got it.
So I talked earlier on the P&L. You saw the without donor restrictions and the with donor restrictions. And one of the areas that nonprofit leaders don't understand is as important as it is this concept of with and without donor restrictions. So when donors give money, they will either temporarily restrict it or permanently restrict it. And it's critical that you comply with their restrictions. Critical. It's not, I'll do it if I want. No, you have to. And here is the example that I give for that. So let's talk about our personal lives again. If Kirsten had her hot water heater break and I gave her money to buy a new hot water heater, I gave her $1,000 to buy a new water heater. Because she is an upstanding moral citizen, she's going to use that money to buy a water heater. That's what I gave it to her for. She's not going to use it to help pay for her family's trip to Disney World. She's not going to do that. And nobody on this call would do that. So when your donors give you money to build a bell tower, whatever you're raising money for, you have to build that bell tower with it. You have no choice. And the only way that you can properly know, well, how much money do I have for the bell tower, is again by properly accounting for it. So back to the previous question, you don't really have a choice. You at least need some bookkeeping because you got to make sure that bell tower money, the ins and outs, is being properly accounted for. You have to make sure that you're not taking any of the money, or that when you spend money on building a baseball field, that you're not taking it out of the bell tower fund. You cannot do that. There's this other concept called permanently restricted. So this is a very real example from my life as an auditor before Chasen. I was auditing a symphony orchestra and it was going bankrupt. And we had a Bill Gates level donor in the community who loved the symphony. And he didn't want it to go bankrupt. So we gave them $55 million. But he said, you can never touch this. And whenever I say this to non-accountants, their eyes get big and they think, I know what their head is thinking. Well, how did he save them if they can never touch the $55 million? Because the $55 million creates income, investment earnings. And for the sake of the simple math in my brain, let's say the market's yielding 10%. So in their case, they had $5.5 million a year coming off that $55 million that in this case, they could spend, as I say, to keep the lights on. That's because this donor said, hey, when you can have the 55 million, you can't touch it. Wasn't there an MC Hammer song about that? Can't touch that. So he said that you can't touch that. But he said the earnings you can use any way you want. Now, that's a little unusual. Oftentimes donors will say, here's my $1 million, don't touch it. But the earnings you can use to pay the musicians' salaries or whatever the donor designates. So in a permanently restricted situation, you often have two donor restrictions. The permanently restricted, don't touch it. And then the temporarily restricted, you can touch the earnings, but you have to use it to pay the musicians' salaries. Or the thing every nonprofit leader wants, permanently restricted, the 55 million, but guess what? You can do anything you want with the earnings. Nonprofit leaders absolutely love that.
We have a question.
Mm-hmm.
Let's see. Is that considered an endowment fund, the permanently restricted?
Yes.
Okay.
That is another name for permanently restricted, is endowment fund.
And then do you mind just a quasi endowment? Do you mind explaining what that might be?
Yeah, I don't mind. That's a super great question too. A quasi endowment. So think of the word quasi, which to me means kind of fake.
Mm-hmm.
So what happens with a quasi endowment is a board of directors will see that unrestricted money is at a nice, healthy level. And they'll say, we want to take some of that unrestricted money and we want to put it in an endowment so that it can start to throw off earnings, because that's a more sustain us through perpetuity kind of investment. So boards will go ahead and take unrestricted money and move it over into an endowment. And so it's called a quasi endowment, because when boards choose to put money in an endowment, they can choose to take it out of the endowment. Whereas if a donor says put money in the endowment, there's no choice. You put it in the endowment and you're done.
But I'm sorry.
No, go ahead.
But a board could choose for it to be fully endowed if they wanted to. Is that right? They
They
could.
100% can,
Okay.
but
Okay.
because the board chose to endow it, who knows, maybe 10 years down the line, they're running short on cash. The board can choose to unendow it and put it back in unrestricted.
Excellent.
So this slide demonstrates the similarity between all of you on this call, your personal finances and nonprofit. The temporarily restricted money is the same thing like when you and I put money away in our emergency fund. And the permanently restricted money is like when you and I put money away for retirement. And in fact, financial planners will tell you when you put your $1 million away for retirement, you should never touch it. You should live off the earnings from your $1 million that you put away for retirement. So there's a huge parallel between your personal money and your organization's money.
Perfect.
And I touched a little bit already about why it's so important to honor your donor restrictions, but certainly it's to maintain your donor's trust. But look at the second one, to uphold your legal obligations, to uphold your legal obligations. And then just to be an effective steward of the money. And because the IRS requires adherence to donor restrictions. And let's be honest, we all fear the IRS more than any other law keeping entity out there. So you don't want to make them mad. I also showed you and brought to your attention on the audited financials how expenses are split between program and supporting services. So now we're going to talk about that and why it's important and why you should really care. So I shouldn't get to that. Let me go back just for a second. So the audited financials will break your expenses between program and supporting services because that's what donors want to see. So this is a true story. I think it was the 90s, late 80s, early 90s. There was a huge nonprofit, like the size of the Salvation Army, that big of a nonprofit. It was not, for the record, it was not the Salvation Army, but it was very, very large like that. And for those of you who were born when the earth cooled, you may remember who it was, because what happened was they were using a disproportionate amount of their money on the CEO's salary and bonus. And the press got a hold of this, and the press went crazy. Now, I didn't name that nonprofit, but for the record, all these years later, they're cleaned up now and everything's fine, so it's not an issue. But at the time, it was a huge political craziness with the press just blowing it up and donors being really, really angry. In response to that, the accountants changed the way they report out to the donors. So now they report, in fact, I don't want to make everybody dizzy, but let me go back to this slide. So now the auditors, you can see, report program expenses. This particular example, they have two programs, animal care and education and outreach, and then supporting services, which is management in general and fundraising. And it's because of that nonprofit with all the bad press that accountants changed to this format, because what a donor or grantor can do is they can say, okay, total expenses are roughly $3 million. And if you can see my cursor, I'm trying to underline that there. Program services are $2.1 million. I'm rounding. So donors and grantors will do the math, which I cannot do I'll do it in my head. So this means 2/3, if I'm doing it right, and Kirsten or Tanaka, anybody correct me here, but 2/3 of expenses are being spent on programmatic services. How did I get that? I rounded this to $2 million and this to $3 million, 2/3. We all know 2/3 is roughly 66%. Again, I'm doing a lot of rounding here in this conversation, but roughly 66% in this example is going to programs. Let's translate that another way. If you give $1 to this organization, 66 cents on your dollar is going to support the program. And then I can't even do this math, but whatever the math is, X% is going to management in general, and X% is going to fundraising and development. The online charity ranking services like GuideStar and Charity Navigator, they will rank you higher if your percentage of program to total is 70% and above. That's kind of their target to give you a better ranking. That said, you have to be legal, moral, and ethical when you break your expenses down into these groups. You can't say, I spent $1 million this year and I want 80% of it to be program, so I'm going to put 800,000 was program. No, you have to do it in a reasonable, logical, and objective manner.
Jackie, are supporting services the same as operational expenses? Are supporting services the same as operational expenses for the sake of
Generally, yes.
Generally, okay.
Yes. Oh, go ahead.
No, there's more to your answer. I'll let you finish.
Well, I have to take a
explain. Yeah.
detour first, but then I'll go back to that.
Okay.
So what you're looking at here is called the Statement of Functional Expenses. Its whole goal in life is to bridge the gap between what you just saw with things broken down by program and management in general, and something that looks more like your budget versus actual report with titles over here that you can understand. So if you look, Kirsten, can you see my cursor on the screen?
I can when you move it around.
Okay. So if
Yes.
I'm moving my cursor around in the column right now, if you go down to the bottom of that, you can see that $3,001,000, which is the same number we just saw on total expenses on the P&L. And it should always be that same amount that we saw as total expenses on the P&L. So what this does is it breaks down, you can see up here, up at the tippy top, we had 1.6 million in salaries and wages. And what this tells your donors and grantors is how much of those salary and wages related to people working in animal care versus education and outreach versus management in general versus fundraising. So let me loop this back, Kirsten, to your question. Are operational expenses usually G&A? Yes, and for example, executive directors usually code their whole salary to G&A, but most executive directors I know do some work in the program, they do some work in the fundraising, and they do some G&A. So those executive directors can split their salaries into those three categories. Another example, which I love to give because it's can be some huge numbers behind this, is something like depreciation expense. Most accountants and executive directors will put depreciation expense all in G&A. It doesn't have to be. Think about a school, a nonprofit school, K through 12. We have a ton of them. They have a huge amount of depreciation because they have a lot of buildings that need and a lot of equipment and a lot of desks and those kinds of things. Most of the square footage of a school, let's call it 90%. By the way, that's just my number. If you are operating a nonprofit school, you'd have to have some logic to this 90% I'm making up. But let's say 90% of your school is classrooms, gymnasiums, all of that is program costs, all of it. So you can take your depreciation, let's say your depreciation is $1 million a year. You could actually allocate 900,000 of that in my example
to program, because it's depreciating the buildings that exist to execute your program, which is to educate children. So there's some
G&A.
costs super easy, like a teacher's salary in my example. You know, to code teacher salary to program, of course. But there's other costs like depreciation you might. And by the way, if you're doing that with depreciation, you can use that same square footage to do it with utilities, garbage pickup. I mean, whatever insurance for your property insurance.
And this becomes so important when we're submitting budgets for grant applications, for example, right? Because technically then a program could, especially if it's housed in a physical facility like that, the program budget could include a portion of what would normally be thought of as a G&A expense or general and administrative. Thank you for putting that in the chat, Tanaka. So, right? I mean,
it could, but of course, I'm going to tell you to read your grant parameters.
Of course.
Because each grant is different and requires different parameters. And ultimately, if you get the grant is a contract. You have to follow the contract. But yes, possibly if the grant parameters allow for that.
We have a couple more questions. Oops, sorry.
It's definitely important if you have an audit and on your tax return that you put some thought into this, because like I said, a fundraiser told me, my big donors look at those tax returns. They go to GuideStar, they look at it, and this is the first place they look.
Okay, question. How important is it to have receipts for the small stuff? $5, $20, $100 in expenses. All these small expenses add up to big numbers. We operate in a market where receipts are not always easy to obtain.
They should be. I mean, and again, I'm thinking when I go, I don't know, to the convenience store and buy some Coke, if I use my credit card and they've got Square, that receipt is emailed. Well, I have a choice. I can say, don't give me a receipt, or email the receipt to my email account. So I know, especially with credit card purchases, nonprofits have a problem with people not turning in their credit card receipts. But you should always be able to get a receipt. And if some vendor's not giving it to you, you should ask them for one. Is it important? So the IRS says you have to have it. So,
okay.
and the best way to solve that is there is technology out there where if I use my corporate credit card and I go buy something for the business on my corporate credit card, I can take a picture of the receipt on the app, and then I can code it right then and there and hit submit, and it goes to the approvers and the accountants for our company and everything we need.
Okay.
So there are ways to make it easy.
People I think that's the key.
Like doing it.
Yes. I think you just have to get in the habit. Find something that's going to work for you and just get into the habit. Okay, a couple more questions. Are nonprofits required to show separately the revenues from extraordinary sources, non-recurring, so as to not overly enhance the total revenues? This is usually done in for-profit organizations.
So typically the extraordinary revenues that nonprofits have are investment revenues, and for your outside facing financial statements. So those were the ones that your auditors do. They weren't that budget versus actual that I'm going to call inside facing. For your outside facing financial statements, auditors will put things like investment revenue down at the bottom, so that you have your normal contributions and so forth, your expenses, a subtotal, and then your investment revenue and any investment expenses at the bottom. This became really important. I'll give you another example. I believe it was 2021, we had a client, the market was very, very good, and they have an endowment, a nice endowment. And if you looked at their bottom line that year, it was a positive $16 million. Well, when you looked at what really happened, it was all from investments. They essentially broke even, and their 16 million profit was investments. The next year in 2022, and I could have my years off by a year, the market tanked. And the next year they had a loss of $17 million. And when you dug into it, it was all investment losses. Again, they broke even on what they normally do, but the investments were losses. So most nonprofits just have that kind of delineation, whereas the person who asked the question, for-profit, has further segmentation of that,
Mhm.
but nonprofits usually don't have those situations.
Great question, though, because it does help to understand how you kind of even things out on the actual revenues that are from operations or donations of that year as opposed to investment.
And as managers, like, we encourage
Mm.
people, when you're budgeting, don't even budget for your investment.
Mhm,
You have no
mhm,
idea. Put
mhm.
it down at the bottom. Don't budget for it. Don't be held accountable for it, because who knows? If I knew what the market was going to do, I would be very rich.
Yes. Okay, one more question since we're talking about revenues still. A nonprofit I'm familiar with receives an annual predetermined donation from an endowment set up under a separate entity. The nonprofit does not own the endowment and probably cannot include it in their assets, but the annual donations are fixed and legally bound. How do we represent that?
That's So my understanding, you've got organization A and organization B, and organization B owns the endowment and controls it and all that. They give organization A, a separate legal entity, money every year. That's revenue. That's contribution revenue. Now, again, nonprofit leaders, you got to dig deeper into that. Did organization B restrict that revenue in any way? So it's revenue, period. But the question is it with restriction or without restriction?
Got it. Did that answer the question, Ken? Yeah. Okay. Excellent. Thank you so much, Jackie.
Okay, now we're going to remember LeBron's career stats, and that is kind of like the balance sheet or a statement of financial position in nonprofit terminology. So here is an example of a balance sheet for a nonprofit. And really, I want to call your eyes down to the very bottom, which is net assets without and with donor restrictions. So for all of you familiar with for-profit financial statements, net assets are retained earnings. This is LeBron's career stats. It's the accumulation of your organization's profit and or loss since its inception. So we just talked about that when you get contributions, they will come in with or without restrictions. If they are with restrictions, what we call temporary restrictions, go build a bell tower, and you haven't built that bell tower at the end of the year, when LeBron's season stats close out right here into his career stats, they will retain that with or without restriction classification. As opposed to if in, let's call it calendar year 2024, you got a donation to build a bell tower with restrictions, you built the bell tower, it's finished by the end of 2024. Well, now that money's not restricted anymore because you used it for what the donor wanted you to use it for. So now when the P&L closes out to the net assets section, it'll close out as without restriction in that particular example. But it's important to note that your balance sheet here in the net asset category retains the character that the contributions had when they hit the P&L. Well, not when they hit the P&L, but at the end of the year in the P&L. Any questions on that one? And I covered those. Common accounting challenges for nonprofits, donor restrictions, which I hit that one to death in here. Grant management, and grant management is challenging for nonprofits because your books are garbage in, garbage out. So if you're not taking the time up front when invoices come in to code them to the right grant, you are going to have grant reports that are a bunch of garbage. And as all of you know, your larger grantors probably require at least annual reporting from you about how you spent the money they gave you. So it's critically important that at the front end, when you are spending money that a grant covers, that you code it to the proper grant. If grant A covers an expense and grant B doesn't, it's really important to not make a human error and code it to grant B when it really should be coded to grant A. And again, modern technology, the kind that has ice cream at my door in 2 hours and is very affordable, can make this very, very, very easy. And then, of course, the compliance challenges. Nonprofits are held to certain transparency standards by the IRS. You have a whole different tax return because even though you're a nonprofit, you still have to file a tax return. You may have, again, charitable solicitations state by state. If you have endowments, you may be subject to MIFA guidelines, which are also state by state. So you've got some regulatory challenges to make sure that you meet. Best practices for nonprofit. Look at that first one, adopt cloud-based accounting software. Again, I'm beating this one to death, but it's the kind of software that has ice cream at my door in 2 hours. Effective internal control, which kind of goes to the previous questioner's question. And nonprofits are, so effective internal controls are designed to do two things. They're designed to prevent and detect fraud and errors. Now, when I say errors, I mean material errors. If you miscode a $5 charge, internal controls aren't going to catch that. If you miscode a $500,000 charge, internal controls will catch that. And they're also designed to prevent and detect fraud. Here is another myth I'm going to bust today. I don't know how many nonprofits tell me, I don't have to worry about that. We get an audit every year. Audits are not designed to catch fraud, and they won't typically. Statistics show they will not catch fraud unless there's a whistleblower. I've been on one of these calls with another CPA who is currently doing auditing, and I've said, call me a liar. And he said, nope, you're absolutely correct. It's the big hurdle that we fight as auditors. Everybody thinks they don't have to worry about internal controls because we're going to find fraud. And he said, no, we do not find fraud. We are there to make sure that your financial statements are materially correct. And if on the way to doing that, we find fraud, we'll let you know, but we generally don't without a whistleblower. It's critical to maintain accurate and timely records. So let me give you a terrible personal example of this. Right before Christmas, right before Thanksgiving, I decided to stop getting on the scale. And I didn't get on the scale again until the end of January. And guess what happened? I had to because my clothes weren't fitting anymore. So, and I say that because if I had gotten on the scale every day or every week, I wouldn't have been 2 months later having to buy a new wardrobe or cutting the chocolate chip cookies and ice cream out of my diet. You can bet I chose the latter because I'm an accountant. We don't like buying new clothes. But if I had been doing it regularly, it would have never gotten to that point. And the same is true with your financial statements. LeBron James reviews his film within 24 hours, I'm going to say. You've got to review your film every single month so that you have time to course correct if something goes wrong. And you need to regularly review your financials, punctuates that point, and analyze them. Now, nonprofit leaders don't get freaked out. Analyzing them means looking at that budget to actual report. Oh, this line's $100 off. I don't care. This line is $80,000 off. I care what's going on there. And then again, comply with all the rules and regulations. Absolutely. And thank you so much for having me. It's been a pleasure.
Yeah, absolutely. Great to have you. All right. We'll see everyone on March 11th. Thank you for joining today. It was a pleasure to have you all. Jackie, thank you again for everything. And we'll see you March 11th for our funder panel. Looking forward to it.